To eliminate the disadvantages of this oscillator, it's necessary to smooth the volatility and set strict borders on fluctuations. With this in mind, J.Welles Wilder developed a new oscillator. It's called Relative Strength Index, or simply RSI. We're going to examine its basic features now. It has just one time parameter, n. We're interested in the behaviour of closing price for the period n. If the closing price is higher than the previous one, then the value is blue. And if it's lower than the previous, the value is red. So the ratio of the sums of positive and negative variations u and d for the period n, expressed as a percentage, is the RSI. Take a look at RSI. Its minimal value equals 0 and its maximum is 100. Its inventor suggested using a time period of 14 for daily charts. It should be noted that RSI almost never reaches its extreme values of 0 or 100 if n is equal to or greater than 14. To get a better understanding of this oscillator, keep your eyes on the level 50. If RSI is greater than 50, there are more positive closing price changes than negative, and today's closing price is definitely higher than closing price 14 days ago. Vice versa, if RSI is less than 50, it means that today's closing price is less than 14 days ago. When RSI equals 50, today's closing price equals the closing price of 14 days ago, just like momentum at 0. Well, we've already studied how to identify price direction, and we know that relative strength index was not developed for trend following. Our goal, and RSI's too, is to identify optimum entry and exit points. RSI fluctuates between 0 and 100, and we draw two horizontal lines within this range at levels of 30 and 70. When the indicator is above 70, it's gone into the overbought zone. The market is overbought. When RSI falls lower than 30, it's moved into the oversold zone. The market is oversold. These zones will look pretty in pink. The sell signal is generated when the oscillator leaves the overbought zone from the top down, and it's wise to buy when RSI gets out of the oversold zone from the bottom up. Notice the arrows. These signals are also pretty sound in a trading range or when a trend is finished. The overbought and oversold zones. It gets really interesting when a chart enters the overbought zone and buying continues for 2 weeks, a month, and then would you credit it, a year? Look at this example comparing a trend with the change of relative strength index. The price will rise till demand is higher than supply. The terms overbought and oversold are misleading. RSI will carry on trying to reach 100 for as long as the price keeps rising, or it can continue striving for 0 while the price is falling. What should we do? Sit on the fence? Hold all trades? No way. Believe me, RSI is an extremely useful indicator. Look at this rising red line. It's a support line, but it's not for price. It's for the RSI oscillator. Every time that the indicator tests and recoils from this support is a good opportunity to go long. But the trees can't reach the sky, and trends, like all good things, must come to an end. So what happens at the top of a trend? Very often when RSI breaks through the support line, it behaves like price. It retests the line from below and then heads off down together with the price chart. On a bear market, our oscillator behaves in a similar fashion. Here we have a daily chart for the Swiss franc. Sell, sell, buy. The RSI oscillator has one more wonderful feature. Wilder called it the failure swing. You'll remember this term from your previous study of chart analysis. Nowadays it goes by a different name: divergence, or a discrepancy. This is what divergence looks like on a bull trend. The last price high is higher than the previous one, and the last oscillator high is lower than the one before. Let's draw two lines, one up line and one down line. There you go, that's your divergence. On a falling market we draw two lines too, but now the down line is on the price chart, that is, the last low is lower than the previous one, and the indicator will have an up line. Divergence strikes again. A divergence is a very strong signal of a coming market reversal. Never, ever ignore it. Although divergences come in different shapes and sizes, all of them are instantly recognizable. Let's check them out. A double top has formed on the daily chart of the euro, and RSI indicates two falling highs. It's a divergence, and it's a strong one. Here we can see a double bottom on the price chart. RSI has formed two troughs, and the last one is higher than the previous. Divergence again. When a divergence forms, what we really like is when the last indicator high is below the signal line of 70, that is outside the overbought zone, and also that the last trough of RSI is above the 30 line outside of the oversold zone, like this. How should we select the time parameter N for the RSI oscillator on daily charts? The developer suggested a value of 14. Other researchers apply a value of 9. Well, let's use a range of N between 9 and 14. We advise setting N at not less than 7 and not greater than 11 for hourly charts. Make a note of these values. Some traders are not satisfied with the choppy appearance of RSI and they smooth the oscillator's line. The usual way of smoothing is to average the indicator's value with a simple or exponential moving average. This is an option in RSI's properties windows in our technical analysis software, Rumus. Please note that the smoothing of the indicator reduces the amplitude of its fluctuations. Because of this, we can change the level of the signal lines to match the averaging value. Here, smoothing is strong, and the overbought and the oversold zones have been widened to 60 and 40 accordingly. RSI is most effective when it's used in conjunction with a trend indicator and chart analysis to identify resistance and support levels and lines.